Good day, ADK Wealth Advisory Group community. Dan Davis, President and co-founder. As we wrap up 2021, it's kind of hard to imagine that we're already there, but what I wanted to focus on today, kind of macroeconomic and all the different markets, concluding with what we've done well, what we feel like we haven't done as well, what we've learned from that, and then looking into next year. So if you take a look at the core of what we're always talking about, it's the economy. And the economy, as we believe, one, we're in mid-cycle. What's indicative of mid-cycle is good equity returns, but lots of volatility. So those 3 to 7% pullbacks happen frequently, on average probably like 3 times a year. The thing that's curious about that is you really never know when does one of those turn into like a 10+% drop. Those are very infrequent mid-cycle, but if you oversimplify it, maybe you have 1 or 2 if a mid-cycle lasts 3 to 4 years. That being said, you can see that we've already had a couple of those 3+% pullbacks. So far we haven't had a 10%, even though we've come close. Our expectations for the economy would be that 2022 possibly even as long as 2023, that will be indicative of the mid-cycle. When you take a look at COVID, we've had the Delta variant, we've had the Omicron variant. When you study history of these types of things, it's an interesting math equation of how they're constantly becoming new variants. Normally, those variants end up being less potent, if you think of it measuring it from hospitalization and death, but there's always the black swan event, which is why every time a new variant comes out, the big market concerns, the big economic concerns, so far we've weathered them pretty well. When I take a look at supply chains, if you really take a look at the why, the deep root is you had so much has been pushed to China, and when you had Trump really beginning the decoupling of the West and the East, or recoupling, if you will, that combined with COVID has really resulted in a lot of supply chain problems. There's other variables as to why that is. I won't hash those because you've read them, but the reality of it is we expect that to be improving but not solved in 2021. And those types of things are really resulting in inflation. And you heard the Fed talk about transient inflation. There are pieces like what we've seen with oil prices being very low and bouncing back to where we feel like it is more of a normal state for them. That creates transient inflation. There's a lot of those types of things. Non-transient inflation really is what's happened with wages and with what's going on with rents. Those are here to stay. What that means to inflation is really yet to be determined, but that inflation will be continuing to go up as a core. Maybe not at the same rate of growth that we've seen, but inflation's here for a while. What that means for the bond market in its simplest form is we have really low interest rates and we're already seeing them going up, which really has a severe negative effect on the overall rate of return. How we've handled that twofold. One is we've lowered our weight in bonds than our norm. And two, as we've discussed before, we moved away from interest-sensitive bonds to more credit-sensitive bonds, which really helped with the portfolio return, because had we stayed where we were, that part of the portfolio would be in negative territory. It's in significant positive territory, so the delta is very favorable. We'll continue to weigh in on that stance. A lot of it just depends on what does the Fed do as to where interest rates are going to go. So historically, if you go back to Greenspan, once the Fed starts raising rates, they typically will raise them about 8 times on average, with about 0.25% per raise. So there's 2 things going on with the Fed. You've got tapering, which they've announced, and then you have raising interest rates. All of that sort of blends together as what I would classify as a negative place for bonds in general. Equities, we expect in mid-cycle that equities have favorable returns, as we alluded to before, with quite a bit of volatility. In looking at that, we've overweighted equities. The benefit of that is if we're correct, we get better returns. The obvious negative is that when we do have those larger pullbacks, we'll see more volatility within the portfolio, which we're willing to live with that risk to avoid the lower potential returns from securities that would be in bonds. So those 3 to 7% pullbacks, just sort of ride through those, really nothing to do. The 10% pullbacks, it just gets down to whether or not we can see enough data-driven points to sort of pull back our weighting or just ride through it. That's going to be a lot of guesswork over the next several years that we'll keep you posted individually as we do that. The thing that we've been really satisfied with on our equity returns is that we've been quite a bit overweight in U.S. large cap, which has been one of the best performing assets. The one thing about equities that I would say surprises me the most is the large variance in returns between U.S. large, foreign, and emerging markets. In my 33 years doing this last year it was the largest variance between the three. Which leads us to the final point, which is the emerging market equities. That's the one that if I were going to pick something that we've done poorly, our outlook on China, as you've heard me say, is we believe that North America and Asia will be the strong performing economies led by the U.S., led by China. And we still believe that, but we always knew there was that communist risk. And so this year, that really played its hand in a really ugly way. And it's not only hurt just China, it's hurt emerging markets in all of Asia. So if I were going to say, what did we handle poorly? That would be an area that's hurt our portfolio returns. The investment committee is really reviewing what's the key learning from this. We're going to be adding a person to our investment committee next year. The purpose of that is right now we look at total market conditions. We've never really looked at isolated markets to determine if we should underweight something when it's having isolated problems. And that would be an area that we'll probably change, is that we'll look at U.S., foreign, emerging markets collectively but separately, where we're using technicals and fundamentals to where we would, in market timing, actually reduce a position if we feel like the technicals are showing negativity there where everything else looks positive, which is the first time that's really happened in my career. I don't think that it's a norm, but I do think it will repeat itself, so we don't want to have that kind of exposure in the future. So if I were going to sort of summarize everything in a nutshell, we're in the mid-cycle. We expect good equity returns, expect neutral to negative bond returns. We've weighted the portfolio as such, and expecting inflation to be around for a while, but the Fed will be responding. So in sort of closing, I'd like to say thank you very much for the trust that you've placed in us. Remember to check in at ADK Wealth Advisory Group's website, Discover Independence, for ongoing updates where we post these videos. There's a whole video section of different topics. And refer your friends if that's something that you think is appropriate. The best way to do that is to send me an email, say, hey, I've got this friend that I think would benefit from your services, forward them these kind of emails or these kind of videos, and then we'll follow up with them. So in signing off, I'd like to just say thank you and salute for the upcoming Christmas and New Year's holiday. Cheers.